Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know First Fed Chair declares AI isn't a dot-com bubble, but a two-tier economy reveals a $1 trillion cash-burning paradox. We'll analyze why this boom is different and how financial engineering like round-tripping could affect market stability and innovation. Second, Microsoft's $3.1 billion OpenAI loss reveals a fracturing alliance as the partners become direct competitors in the AI race. We'll break down this critical co-opetition development and what it signals for the Azure and OpenAI platform ecosystems. Third, Meta's $70 billion Metaverse loss is eclipsed by its Ray-Ban smart glasses, signaling a major pivot to ambient AI. This discussion will reveal how this shift connects to the larger trend in wearable AI and what it means for the future of tech. Fourth, how a one-man VC turned a gut instinct bet into a $1 billion payday from Navan's IPO, disrupting venture capital. We'll explore how this solo investor model could transform funding decisions and what it means for Silicon Valley startup dynamics. Fifth, big tech's AI arms race ignites as spending hits hundreds of billions, fueling Nvidia's $5 trillion valuation. We'll examine how this compute oligopoly may impact innovation cycles and put unprecedented strain on global power infrastructure. The head of the Federal Reserve just drew a line in the sand on the AI gold rush, declaring it is not the dot-com bubble all over again. Federal Reserve Chair Jerome Powell went on the record with a bold statement saying, quote, "This is different in the sense that these companies, the companies that are so highly valued, actually have earnings and stuff like that." And he's not wrong, but his focus on just the financial metrics might be missing some huge non-financial risks. We're talking about things traditional economic models don't really track, like the massive energy and water demands of these AI data centers straining power grids, or the incredible supply chain risk of having so much of the world's AI hardware dependent on a single company. A while back, we highlighted how this build-out is accelerating. Google is aiming to bring over 1 gigawatt of AI compute online by 2026, and Amazon turned Indiana cornfields into live data centers almost overnight with Project Rainier. Research we cited suggested data centers could consume up to 9% of US electricity, exactly the kind of externality Powell's comment doesn't capture. He's pointing to the titans of the industry. Chipmaker Nvidia has exploded to become the world's most valuable company, with a market cap surpassing an astronomical $5 trillion. That rally is built on the graphics processing units that are the beating heart of the entire AI revolution. Powell argues that this, along with massive investments in data centers, is a major source of real economic growth. As we've discussed before, rivals are hustling to reduce single vendor risk, Google pushing TPUs and Amazon pushing Trainium, sometimes even lighting up facilities where Nvidia is, quote, nowhere to be found by design. So what we're witnessing is the emergence of a two-tier AI economy. You have the hardware layer dominated by Nvidia, which is massively profitable. Research shows their gross margins on these essential GPUs can be around 80%. They are selling the picks and shovels in this gold rush. Everyone needs their hardware, so they're making real tangible cash. But that's not the whole picture. The situation presents a fascinating duality. While giants like Nvidia are posting massive profits, a new class of high-flying startups is burning cash on a scale that is hard to comprehend. OpenAI has locked down a mind-bending $1 trillion in AI deals. The catch? The company is projected to generate only $13 billion in annual revenue. This brings us to the second tier of the AI economy, the software and model makers. The cost to simply train a cutting-edge model like GPT-4 is estimated to be somewhere between $50 and $100 million. That's not to sell it, just to build it. They are spending fortunes on computing power before they've even figured out a clear path to sustainable profit. And it's not an isolated case. Anthropic, another major AI player, just announced a $50 billion cloud partnership with Google. As we covered a while back, that pact included access to up to 1 million of Google's custom TPUs and a target of more than 1 gigawatt of compute by 2026. And remember, Anthropic's single biggest backer isn't Google, it's Amazon, with roughly $8 billion committed and a role as its chief cloud provider. It's that enemy of my enemy is my friend co-opetition we talked about, a deliberate counter to the Microsoft OpenAI alliance. Anthropic's strategy has been integration first, with a hardware arbitrage twist running across Google's TPUs, Amazon's Trainium, and Nvidia's GPUs to squeeze price and performance and avoid getting locked in. Now, get this. How can these deals make any financial sense? Well, what's happening under the hood with some of these massive partnerships is a practice some in Silicon Valley are calling round tripping, or a cloud credit shell game. A cloud giant like Google or Microsoft invests billions in an AI startup. But a big part of that deal requires a startup to spend that money back on that company's cloud services. So the investment money essentially goes out the front door and comes right back in the back door as revenue for the cloud provider. We broke this down a while back, and it's exactly why headline deal sizes between cloud platforms and model labs can look bigger than the underlying independent demand, clever financial engineering that's hard to untangle in real time. This all points to the core conflict defining this new era. We have established players with real massive earnings, validating the hype. At the same time, we have the next generation of innovators betting the farm on future growth, spending astronomical sums before the revenue catches up. And this leads to the big question that economists are starting to ask, echoing the early days of the internet. It's called the productivity paradox 2.0. With all this investment and all this hype, why aren't we seeing massive economy-wide jumps in productivity yet? In reality, it can take years for these foundational technologies to be integrated properly and for their benefits to show up in the official numbers. At the micro level, we've seen real wins. Like a while back when we highlighted Novo Nordisk cutting a documentation workflow from more than 10 weeks to just 10 minutes on Claude, but scaling those gains across entire sectors takes time, standards, and integration. So while this may not be the dot-com bubble, it's a high-stakes boom with its own set of rules, where trillion-dollar deals are being signed on the promise of a future that is still being built. Speaking of high-stakes financial engineering, let's zoom in on one of the key players. Microsoft just took a $3.1 billion hit to its net income. That single number, buried in its latest earnings report, signals a massive shift in the world of artificial intelligence. That hit is an accounting loss, not a real-world cash loss, and the story behind it reveals a strategic masterstroke. It's fueling explosive growth in Microsoft's Azure cloud business, with AI services on track to become a $10 billion a year business, the fastest growing in the company's history. So while the accounting books show a loss, the reality on the ground is a massive strategic win. A while back, we said the AI arms race is now measured in megawatts, not headlines, the kind of scale where an $11 billion data center isn't enough to lock in anyone's loyalty. This number fits that pattern. The hit is a direct result of Microsoft's massive investment in OpenAI, the company behind ChatGPT. On an earnings call, Microsoft CEO Satya Nadella called the relationship one of the most successful partnerships and investments our industry has even seen. Microsoft has committed $13 billion to OpenAI, and its stake is now valued at a jaw-dropping $135 billion. That $13 billion investment was crucial. It secured Microsoft a 27% stake in the hottest company on the planet, cementing its place at the absolute center of the AI universe. This is where the situation takes a more complex turn. While the CEO praises the partnership, Microsoft's own official filings tell a different story. For the first time, Microsoft has officially listed its partner OpenAI as a competitor. The companies that defined the AI boom together are now becoming rivals. We previously analysed how co-opetition was hardening across the industry. Remember Anthropic taking billions from both Google and Amazon, and the latest development is that the same dynamic is now squarely between Microsoft and OpenAI. This kind of frenemy paradox isn't new, of course. Think about Apple and Samsung. For years, Samsung has been one of Apple's biggest suppliers for iPhone screens, even as they were locked in a brutal global war for smartphone dominance. This relationship, where you both collaborate and compete, is called co-opetition, and it almost always leads to an explosive mix of innovation and conflict. And the battle lines are being drawn. OpenAI announced a prototype search engine called Search GPT, a direct challenge to Microsoft's core business. In a clear countermove, Microsoft has started publicly testing its own homegrown AI models to power its Copilot assistant, reducing its reliance on OpenAI's technology. What's more, this isn't just about software. Microsoft made a massive strategic move by hiring Mustafa Suleyman, one of the original co-founders of Google's DeepMind AI lab, to lead its new consumer AI division. This is a clear signal that Microsoft is not content being a passenger. It is building its own engine to compete head-to-head. And believe it or not, the two are also locked in a complex financial relationship. OpenAI has contracted to purchase an almost unbelievable $250 billion of Azure cloud services from Microsoft. A few days ago, we mentioned how Anthropic secured access to up to 1 million of Google's custom TPUs and targeted a gigawatt of AI compute by 2026. Numbers like that explain why OpenAI's Azure commitment exists at all. That $250 billion figure isn't just a number, it's a new baseline. It tells us the staggering cost of competing at the frontier of AI development. The sheer amount of computing power needed to train and run these massive models is so immense that it's creating a new economic reality for the entire industry. As we discussed a while back, the scramble for capacity is forcing everyone into multi-front strategies because scale, not promises, decides who ships. Yet, in a crucial change, Microsoft no longer has the right of first refusal as OpenAI's primary compute provider, opening the door for other tech giants to step in. This is a critical development because it fundamentally weakens Microsoft's strategic lock-in. Losing that exclusive right means OpenAI is now actively diversifying. Reports show it's already making deals with Microsoft's biggest rivals, like Google Cloud. We previously analysed Anthropic's multi-chip, multi-cloud approach with Amazon on one side and Google on the other. OpenAI's shift lands in that very same lane. The alliance that kickstarted the entire AI revolution is now fracturing. What was once the industry's most powerful partnership is quickly turning into a high-stakes rivalry, pitting two of the biggest names in technology directly against each other for control of the future. Speaking of high-stakes bets, Microsoft isn't the only giant navigating a tricky path. Over at Meta, they're facing a multi-billion-dollar reality check. Let's start with a single statistic that might just change your entire perspective on the company. Meta's Metaverse division has now officially lost over $70 billion. That's not a typo. $70 billion. Since late 2020, the company's Reality Labs has been a cash inferno. Now, while that number is astronomical, it actually fits a pattern in big tech known as a moonshot investment. Think of Google's Other Bets division. These are massive, long-term bets on future technologies. Meta's own finance chief has publicly called Reality Labs a strategic long-term priority, signaling to investors that they are playing a very long game, even if it looks like they're just burning cash. In the last quarter alone, it posted a staggering $4.4 billion operating loss. And for all that spending, the revenue it generated was just $470 million. However, if you zoom out from the VR losses, you'll see another layer of strategy at play. A completely different product is emerging as a surprise hit. The new AI-powered Ray-Ban smart glasses are seeing what the company calls strong demand. This partnership with EssilorLuxottica, the fashion conglomerate that owns Ray-Ban, is a masterclass because it avoids the mistakes of past failures like Google Glass, which was seen as a tech gadget first. By integrating technology into an iconic fashion accessory, they are creating a wearable that people actually want to wear. This collaboration is so serious that their agreement now extends beyond 2030. So strong, in fact, that Ray-Ban's parent company, EssilorLuxottica, went on the record in their own earnings call, stating the new wearables helped lift its sales. A while back, they told investors sales jumped nearly 12%, with over 4 percentage points of that growth coming directly from the Meta Wearables partnership. And CFO Stefano Grassi didn't mince words. We believe that glasses will be the future. Glasses will materially replace most of the functionality that today we have embedded into our phones. They've even said the wearables line is already profitable and is ramping production faster than planned. This signals a potential pivot from immersive VR to what experts call ambient AI. Immersive VR, like the Quest headset, takes you out of your world and puts you into a digital one. Ambient AI does the opposite. It weaves technology seamlessly and invisibly into your real life. The glasses are the first step. And as we noted before, the real play isn't just hardware units, it's recurring revenue from prescription lenses and AI services stitched into those frames. What really brought this to a head was a key personnel change. Vishal Shah, the executive who was leading Meta's entire Metaverse initiative, has just been moved. His new title is Vice President of AI Products in the company's Superintelligence Labs division. The man in charge of the metaverse is now working on AI, and inside those labs, they're building on technology from a company Meta acquired years ago called Control Labs, which was developing a neural wristband. This device doesn't use cameras. It uses something called electromyography to read the electrical signals your brain sends to the muscles in your arm. It's a wild concept. You could control your glasses or other devices with tiny, almost invisible finger movements that the wristband detects. That's exactly why we said the AI that lives on your face becomes the battleground. When we place Meta's approach alongside Apple's, the contradiction becomes clear. Apple's Vision Pro relies on cameras to watch your hand gestures. Meta is betting on a future where your thoughts can translate into action with no visible movement at all. And as we flagged a while back, Apple and even OpenAI are lining up to enter the smart glasses arena. Meta's $70 billion bet is facing a reality check, and it's coming from a popular pair of smart sunglasses. While tech giants like Meta are spending tens of billions to find their next big thing, a completely different story is unfolding in the world of venture capital, where one man just turned a gut feeling into $1 billion payday. The most unexpected news in the venture world today has to be this: a self-proclaimed one-man VC who operates completely alone just turned an investment into a $1 billion payday. No team, no secretary, not even an office. He takes most of his meetings from a single coffee shop in Palo Alto. This one-man VC model, often called a solo GP or solo general partner, is a fascinating and disruptive trend. The advantage is incredible speed and agility, which is very attractive to founders who want quick decisions. Interestingly enough, this solo model runs counter to a broader trend in venture capital. Data shows that among new managers, the split is moving towards more team-led funds, which can offer more diverse perspectives and avoid the potential biases of a single decision maker. That one-man operation is Oren Zeev, and he's just redefined the blueprint for investing success. As a solo general partner, Zeev is now managing a staggering $2.5 billion in assets and sits on the board of 40 different companies. And being on the board of 40 companies is no small feat. It comes with legally binding responsibilities called fiduciary duties. These include the duty of care, which means a director has to be informed and diligent, and the duty of loyalty, which means always acting in the company's best interest. The big question experts are asking is whether any single person can realistically provide that level of deep, focused oversight for 40 different companies at once. The risk is creating rubber stamp boards that don't provide true governance. His secret weapon? Speed and gut instinct. He makes most investment decisions within 24 hours. His approach is striking because the entire venture capital industry is currently in a tug of war between this old school gut instinct and a new data-driven approach. While Zeev is betting on people, other firms are building powerful AI systems to analyze thousands of deals using data to predict success. What's interesting is that some studies show these data-driven VCs actually invest in about 30% more female-led startups than their peers, suggesting that algorithms might be helping to reduce natural human bias. This billion-dollar win comes from the IPO of corporate travel company Navan. So what is Navan and why is it worth so much? The company started as a corporate travel booking platform, but its real genius is that it evolved into an all-in-one platform for travel and expenses. This decision brings both a huge differentiator and comes with inherent risks. While newer fintech companies like Brex and Ramp are focused on corporate cards and spend management, and legacy giants like SAP Concur have the market share but are often seen as clunky, Navan created a single user-friendly place for everything. You book your flight and file your expenses in the same app. That unified experience is the real battleground for winning the enterprise wallet. But the story didn't start with $1 billion idea. It started with a $50,000 relationship investment in the founder's previous company, which didn't even have a clear product. Zeev's reasoning? I just liked them. I just wanted to be close to them. That gut bet paid off. When the founders started Navan, Zeev went all in, but the journey was almost a complete catastrophe. When the pandemic hit, business travel evaporated and the company went from rapid growth to a complete standstill, laying off a quarter of its workforce to survive. And navigating the storm was more than just waiting. It was a frantic, high-stakes pivot. The company had to rapidly re-engineer its entire identity and its technology to become a broad expense management platform. When you make changes that fast, You accumulate something called technical debt shortcuts in the code that make future development slower and more difficult. Managing that debt while fighting for survival is one of the hardest things a tech company can do. While Zeev's $1 billion stake is a landmark achievement, he says it's just the beginning. In his own words, I actually don't think it will remain unique for a long time, as I have several companies I expect to follow in the next few years. $1 billion win for a solo investor is incredible, but that sum is almost a rounding error compared to the capital expenditure tidal wave we're now seeing from the biggest names in tech. Alphabet just shattered its own forecast, raising its capital expenditure estimate for 2025 to a range of $91 to $93 billion. To put that in perspective, their earlier forecast was $75 billion, and it doesn't stop there. The company's finance chief is now expecting a significant increase in spending for 2026 on top of that. And it's not just Google. Meta hiked its spending guidance for the year to $70 billion, with CEO Mark Zuckerberg saying that making a significantly larger investment here is very likely to be a profitable thing. Not to be outdone, Microsoft's capital expenditure last quarter hit nearly $35 billion, blowing past its own $30 billion estimate. A while back, we walked through Amazon's $11 billion Project Rainier, a purpose-built AI campus that went from cornfields to data centers almost overnight, and notably with Nvidia chips largely out of the picture by design. That earlier snapshot now looks like the template: build faster, spend bigger, and when it makes sense, diversify the silicon. So what is all this money actually building? This isn't just numbers on a spreadsheet. It's a physical transformation of our planet's infrastructure. These billions are being poured into massive, power-hungry data centers. The International Energy Agency projects that because of global data center electricity demand will more than double by 2030. To put that in perspective, by that same year, data centers in the US alone are expected to consume more electricity than all of our country's energy-intensive manufacturing combined. As we discussed, when Rainier came online, converting farmland into compute has real local consequences, from substation upgrades to community strain, and some researchers even pegged future US data center load as high as about 9% of total electricity. The immediate problem is that our local power grids simply aren't ready, which could lead to real-world power constraints. The crux of the story is that the floodgates are open. The demand for artificial intelligence services is so intense that these giants are in a battle for technological supremacy, and they're fueling it with unprecedented amounts of cash. All this spending creates what some experts are calling a compute oligopoly. The cost to compete at the highest level of AI is becoming astronomical. For example, research shows that training and operating a single state-of-the-art AI model can cost over $1 billion a year. We previously analysed how Anthropic deliberately mixed hardware, AWS Trainium, Google T, PUS, and Nvidia G PUS to arbitrage price and performance. That kind of heterogeneity might soften any single vendor's grip, but it doesn't lower the bar to entry. If anything, it adds a complexity tax on top of the cost. Think about it, we could be watching innovation get cornered by the few companies rich enough to play the game. While all this is happening, the Federal Reserve is tapping the brakes, with Chair Jerome Powell warning that an expected interest rate cut in December is not a foregone conclusion, sending a chill through the broader markets. But in the middle of this spending frenzy, one company just hit a number that changes the game. Fueled by this AI demand, Nvidia's market capitalization soared past $5 trillion, making it the first company in history to break that barrier. And yet, as we noted with Rainier, even the headline maker isn't everywhere. Some of the newest campuses are intentionally built around alternative chips. Nvidia may be the scorekeeper, but the game is being played across multiple architectures. And of course, it's not just about Nvidia's chips. This demand surge creates a massive ripple effect across the entire supply chain. The hidden winners here are the companies building the essential support systems, the power infrastructure, the advanced networking, and especially the cooling systems. In fact, with AI driving server rack power densities to insane levels, liquid cooling adoption in data centers is projected to jump from just 14% to over 33% in a single year. The speed advantage matters too. The players who can stand up capacity fastest, think cornfields to data centers, speed capture demand as it appears, not quarters later, while rivals have reportedly resorted to temporary tent structures just to keep up. That's a massive industrial shift happening at light speed. while Alphabet, Meta, and Microsoft all beat earnings expectations. With Alphabet's quarterly revenue topping $100 billion for the first time, the real headline is the money they're about to spend. The final takeaway is that as confident as these executives sound, this is a monumental gamble. The business models to actually make trillions from these billions in spending are still largely unproven. There's a real question of whether this is a clear path to profit or a defensive arms race that could lead to the tech industry's version of the dot-com era's dark fiber glut miles and miles of overbuilt, underused infrastructure. The race is on, but the finish line is far from certain.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.